All right, welcome to The Explainer. Today, we're unpacking what is absolutely, without a doubt, the definitive wealth building manual of the century. We are talking about the Little Book of Common Sense Investing by the legendary John C. Bogle. Now, if you don't know him, Bogle is the founder of the Vanguard Group and literally the creator of the world's first index mutual fund. So, whether you're a total beginner trying to figure out where to start, a finance student, or honestly just a seasoned investor who is sick and tired of paying ridiculous fees, you are in the perfect place. We're going to uncover this book's ultimate playbook for long-term wealth. And you know what? It all starts with a completely counterintuitive idea. So what if the secret to stock market wealth isn't picking winning stocks? What if it isn't timing the market perfectly or, being glued to financial news 24/7? What if the real secret is just standing perfectly still? For decades, the traditional Wall Street narrative has essentially told us that we have to actively trade, we've got to outsmart the competition, and we need to constantly shuffle our portfolios around to get rich. They sell us this illusion that complexity automatically equals profit. But Bogle's entire philosophy, it flips that completely on its head. He proves mathematically that frantic activity is actually the exact thing destroying your returns. To really get why, we need to look at a fascinating story Bogle uses to lay the foundation for his whole thesis. Okay, let's dive into this. Act 1, the illusion of activity. Bogle introduces us to this hypothetical, ultra-wealthy family called the Gotrocks. Imagine, a long time ago, the Gotrocks family literally owned 100% of every single business in the United States stock market. And because they owned the entire market, they naturally collected all of the dividends and all of the earnings growth that corporate America generated every single year. Their wealth just grew in lockstep with the economy. It was this perfect, frictionless system. They didn't have to do anything except sit back, hold their shares, and watch the wealth roll in. But, well, human nature being what it is, a little greed inevitably crept in. See, some family members decided they wanted to grow their wealth faster than their cousins. So what did they do? They started hiring helpers. In year one, they hired stockbrokers to trade shares among the family, and they paid them commissions for it. Did it actually create more total wealth? No way. It just shifted the existing wealth around while the brokers took a nice little cut. By year two, they hired active fund managers to pick the quote-unquote best stocks, paying them management fees. And by year three, they brought in elite financial planners and consultants, paying them advisory fees. And on top of all that, all this constant buying and selling triggered massive capital gains taxes. Every single time they hired a new helper, a slice of the family's total wealth was just siphoned away by fees, commissions, and taxes. The total pie wasn't getting any bigger, their slice was just getting smaller and smaller. Finally, the wisest, oldest member of the family called an emergency meeting and basically said, fire all the helpers and let's go back to just holding all the stocks. And this brilliantly illustrates a famous quote from the legendary Warren Buffett. He said, "For investors as a whole, returns decrease as motion increases." Think about it. Investing is inherently a zero-sum game before costs are deducted. For every buyer, there's a seller. But after you deduct the costs of trading, the management fees, the taxes, investing literally becomes a loser's game for the group as a whole. The Gotrocks family learned the hard way that the financial industry doesn't really create wealth. It mostly just extracts it. The more active you are in the market, the more you pay the croupiers at the Wall Street casino. Act 2. The relentless rules of humble arithmetic. This is exactly where Bogle shifts gears from storytelling straight into the hard, unforgiving math. Now, to understand the math, we absolutely have to talk about the expense ratio. Simply put, this is the annual fee you're charged to have someone manage your money. Active funds often charge 1 to 2% every single year. Meanwhile, index funds can be as low as 0.03%. Now I know what you're thinking. Come on, it's just 2%. I still get to keep 98%, right? Well, Bogle's math shows that over a lifetime, that tiny, seemingly harmless percentage actively destroys the miracle of compounding. Let's move to and see how this builds with Bogle's simple math. Imagine you invest a single $10,000 sum over a 50-year investing lifetime. Let's assume the stock market gives you a solid 7% annual return. If you invest that in a low-cost index fund, keeping virtually all of that 7%, your money miraculously compounds to $294,570. But if you invest that exact same $10,000 in an actively managed fund that earns the exact same 7% gross return, but they charge you a 2% expense ratio, your net return drops to 5%. Over those same 50 years, your final value is only $114,674. Just let the absolute shock of that staggering number set in for a second. $179,896. That is how much of your potential wealth simply vanished into thin air.
Well, actually, scratch that. It didn't vanish. It went straight into the pockets of Wall Street managers. Because of a quote-unquote harmless 2% fee, you literally lost over 60% of your total potential wealth. Think about that. You put up 100% of the capital, you took 100% of the risk, but the financial system walked away with 60% of your return. Bogle calls this the tyranny of compounding costs. When you really grasp this math, you realize that in investing, you get exactly what you don't pay for.
So, the choice between these two approaches becomes incredibly clear. Active funds, they rely on high fees to pay their managers, high turnover, which triggers massive taxes, and honestly, they usually lead investors to make really emotional decisions, like buying the hottest tech sector fund at the absolute peak or panic selling everything during a crash. Index funds, on the flip side, are the epitome of boring, beautiful common sense. They boast rock-bottom fees, extremely low turnover, which minimizes your tax drag, and they enforce a passive discipline. You aren't out there trying to outsmart the market, you just become the market.
So, the crucial point is captured beautifully in Bogle's most famous piece of advice. See, the financial industry desperately wants you to believe that if you just research hard enough, if you just read enough reports, you can find the winning active manager, the needle in the haystack. But the statistics are just brutal. Over the long term, less than 1% of active funds consistently beat the market. Finding that needle is nearly impossible, and it relies way more on luck than skill. So Bogle's timeless advice? Don't look for the needle in the haystack, just buy the haystack. Just buy the total market index, guarantee your fair share of corporate America's growth, and go get on with enjoying your life.
Act 3. Owning the haystack. This right here is your definitive wealth-building playbook. Let's get into it.
Now, look, Bogle totally gets that human beings aren't robots. We get bored. Sometimes we just want a little bit of excitement with our money. To address this, he introduces this absolutely fantastic asset allocation rule. He basically divides your portfolio into two buckets. The massive 95% portion is your serious money. This is strictly for broad-based, low-cost index funds. This is the solid bedrock of your financial future, and you do not touch it. But for that remaining 5%, Bogle calls this your funny money. If you have an itch to pick individual stocks or maybe buy some cryptocurrency or bet on a specific market sector, you can use this tiny, safe 5% outlet. It gives you the thrill of speculation, but without risking your actual long-term financial security. It's just a highly practical way to protect yourself from your own emotions. So, to sum this whole thing up, John Bogle's wealth-building philosophy really just comes down to 4 incredibly simple steps. Step 1, buy the entire market using an index fund. Step 2, keep your costs and expense ratios radically low. We're talking targeting fees below 0.20%, ideally even below 0.10%. Step 3, stay invested forever. Let the sheer magic of compounding do all the heavy lifting over the decades. And step 4, ignore the market noise. When the talking heads on TV are screaming about an impending crash and the sky falling, don't do something, just stand there. Simplicity truly is the ultimate sophistication when it comes to your money. So, I want to leave you with this final, kind of provocative thought to ponder today. How much of your future wealth is currently being eaten by hidden fees? Seriously, if you have a 401k, an IRA, or just a regular brokerage account, I highly challenge you to log in right after this and check the expense ratios on the funds you own. Are you accidentally paying some Wall Street helper 1 or 2% a year just to lose to the market? Remember, guys, it's your money, it's your risk, and it is your future. Keep your costs low, buy the haystack, and let common sense guide you to true wealth. Thank you so much for hanging out with me on this explainer, and I'll see you next time.